Have you ever dreamed of quitting your 9 to 5 and living off passive income? Imagine waking up every morning without an alarm clock, knowing your investments are paying the bills. Sounds amazing, right? Today on Wall Street Trends, we're talking about exactly how much SCHD, yes, the Schwab US Dividend Equity ETF, you need to retire comfortably. If you're ready for financial freedom and early retirement, keep watching. What is SCHD? SCHD is an exchange-traded fund that invests in some of America's top dividend-paying companies. Think of it like a basket of stocks, household names you might recognize. These companies not only pay dividends, but many of them have a history of increasing their dividend payouts over time. Because SCHD focuses on dividend growth and quality, it's become a popular choice for investors who want consistent, growing income. But how do we figure out how much of it you need for your own retirement? Let's dive in. Defining your annual income goal. First up, decide how much money you need each year to live comfortably in retirement. This depends on things like your rent or mortgage, food, healthcare, and hobbies. Maybe you plan to retire with $40,000 a year in expenses, or maybe $60,000. Well, pick a realistic number based on your situation and then ask yourself, will I have other income sources? Maybe Social Security or a small pension. If you expect $15,000 a year from Social Security and your total expenses are $40,000, you'll need your investments to cover the remaining $25,000. Here's a simple formula to figure out how much you need invested in SCHD. SCHD's dividend yield can vary, but let's assume it's around 3.5%. If you need $25,000 from dividends each year, $25,000 divided by 0.035 is approximately $715,000. So you'd need about $715,000 invested in SCHD. If the yield is higher, say 4%, that number goes down. If it's lower, say 3%, you'd need more. It's always better to be conservative and aim higher to give yourself a cushion. Why dividend growth matters. SCHD isn't just about the current yield, it's also about dividend growth. Over the years, SCHD has raised its dividend at a rate that often beats inflation, helping your income keep up with rising costs. That's crucial, because if your dividend grows 5% or 7% each year, your purchasing power in retirement stays strong. But remember, nothing is guaranteed. Dividends can fluctuate and economic downturns can hit companies hard. That's why having an emergency fund and a well-rounded portfolio is still important. Tax considerations. If you're investing in SCHD through a taxable account, you'll have to pay taxes on those dividends. In a Roth IRA or 401k, you could enjoy tax-free or tax-deferred growth, which boosts the power of compounding. So before you jump into SCHD with both feet, think about which type of account is best. It could save you thousands in the long run. The 4% rule versus dividend only. Some people love the idea of living strictly on dividends so they never have to sell shares. Others follow the 4% rule, where they withdraw 4% of their portfolio each year, dividends plus maybe selling a bit of stock. Either approach can work, but if your aim is a truly passive income stream, focusing on high-quality dividend payers like SCHD can be a solid strategy. Just don't rely on one ETF alone. Consider mixing in other assets for diversification, like bonds, international stocks, or real estate. Real-life examples: meet Sarah. She wants $40,000 a year to retire. She expects $15,000 from Social Security, leaving $25,000 to come from her investments. She chooses SCHD with a 3.5% yield assumption. That means $25,000 divided by 0.035 equals $715,000. If Sarah invests $715,000 in SCHD, her projected dividends might cover that $25,000. If she's lucky, the dividends could grow each year, giving her a raise in retirement. Of course, yields can change, so she plans for some flexibility in her budget. Action steps to build your SCHD position. Want to start building your SCHD position? Here's a quick checklist. 1. Calculate your savings rate. Figure out how much you can save every month. 2. Automate your investments. Set up auto contributions to SCHD or a broader portfolio so you don't have to think about it. 3. Reinvest dividends. While you're still growing your portfolio, turn on dividend reinvestment to benefit from compound interest. 4. Review and adjust. Each year, review your progress, check SCHD's dividend trends, and adjust your plan if needed. Conclusion. So, how much SCHD do you need to retire? Use the formula, do the math, and remember, everyone's situation is unique. SCHD can be a powerful tool in your financial freedom plan, but no single ETF should be your entire strategy. If this video helped you understand dividend investing, early retirement, or passive income, be sure to like, subscribe, and hit that notification bell so you never miss a future video. Thanks for watching Wall Street Trends. We'll see you in the next one. This content is for educational purposes only. Always do your own research or consult a licensed financial advisor. Investing involves risk, and past performance does not guarantee future results.